Now to Karnataka Bank, and here the stock is under pressure. The net interest income of the bank was down 6.4%. The net interest margin NIMs have contracted. That said, the asset quality has improved. We have with us the MD and CEO of Karnataka Bank, Srikrishnan, joining in. Thank you very much, sir, for joining in. This is Reema here. First, if you could talk about this NII decline that we've seen in the quarter. What is the reason behind that, and do you anticipate growth in Q1 and FY26?
Thank you for this opportunity. Specifically on the overall results, I'll talk about it later. But on NII, your question is that, there is a decline. This is a market phenomenon, as you're aware, that, there have been 2 rate cuts. Over 70% of our loans are EBLR linked. And of course, this is, when I say EBLR, external benchmark to the Treasury bills. Fortunately, the Treasury bills is not corrected as much as Repo in the past. And that is very good news for us. So we believe that this is in a steady state and will continue to be as we grow our asset book. So the next year, which is this financial year, the NII will increase marginally. But however, this would be a conjunction of the growth in the book.
What about advances growth then? Your advances growth on a gross level was up about 6.8%. Retail is up close to about 15.5%.
Right. Correct. So this is the focus for us. What we are doing is that, there is a churn that we are doing as far as our overall advances book is concerned. There were some bulk advances which we have had in the past, which we have turned around and churned around rather. And the second is that we have some large NBFC advances also, which we are now kind of shifted to direct to corporate. So between retail and the direct to corporate, mid-market, mid-corporate, as well as the large corporate direct to lending to them, we have increased the book by over 7,000 crores. So this is where I believe that the growth will happen, and that will also have a significant improvement in the yield because the earlier assets that were put were opportunistic because of the surplus liquidity in the bank. Our deposit franchise is doing well. All the various financial metrics of the bank, capital adequacy, LCR, our PCR, our NPA, slippages, credit costs, everything is very, very favorable. We are very well poised as a bank for this financial year.
Mr. Srikrishnan, good morning. Thank you for joining in. The street is looking for some numbers, sir. You mentioned that your net interest income will grow marginally from what it was in FY25. If you could quantify marginally, and if you could also specify the loan growth and deposit growth targets that you have set for FY26.
So why I said marginally is because the market is anticipating some more cuts, which you are aware. So what will happen is that while we will be able to maintain the margins, the NII is not really the function of making profits alone. So there are other parameters. As far as the loan growth is concerned, this year we believe that the book will grow by about 14%, but that will also include some amount of retiring bulk advances again this year. So technically, the book will grow much more than 14% in our case. Likewise, on the deposit side, we believe that the growth will be averaging anywhere between 10% to 11%. But the idea here is that between advances and the deposit numbers, based on the bank's position, we are calibrating because we do not want a deposit franchise kicking in without opportunity to lend. And that has been happening in the past, which is why our CD ratio was low in the mid-60s about 2 years ago, which we brought to mid-70s. And we believe that, it will really increase as we go forward if we are working towards the right kind of targets on the advances and also ensuring that the supply of funds from the deposit franchise is calibrated.
This 14%, book guidance, advances guidance, that's at a gross level or retail?
That's at the gross level, please. And so our 78,000 book will be closer to 90,000 crores.
And retail in that would be growing much faster.
Of course. So that has been the phenomena last 12 to 18 months right now. And our deposit franchise as well as our retail asset franchise both have sales structures now, which was not the case in the bank. And because of this, there is outbound sales. We also created various processes whereby we have created the retail asset centers in 2 locations, and we are going ahead with other locations also. So these are all investment phases in the bank right now.
Okay. Sir, on your advances, just trying to understand the way your NIMs will move from here on. What percentage of your loans are linked to Repo, MCLR or fixed price loans? And what is the outlook on net interest margin considering we are in a rate cutting cycle?
So we have over up to 70% of our loans, which is external benchmark, basically treasury, linked treasury bills. So this is not repo, and the balance is all floating rate interest. And this again has a quarterly reset, and this is more for the larger corporate advances. So as a result, what happens is that we are very closely linked to the market, and EBLR T-bills, as you know, is not reacting the same way as a repo rate cut in a falling interest rate scenario. And that is something the bank is well positioned for. And we believe that, there will be advantages for the bank in this financial year.
Mr. Srikrishnan, your deposit growth has outpaced advances, but your CASA was down. So does that mean that your higher share of term deposits, and are you pushing for more term deposits this time around? And if that is the case, what does that do for your incremental cost of funds? If you could share a number on that, sir.
So just to clarify there, the CASA has not come down. It was 31.94% the previous year. We are 31.75%. So there is not much of a difference there. We have actually grown alongside the growth in the overall deposit number. That is one. Secondly, we are also doing a churn on the retail term deposits, because retail term deposit is a big push for the bank, and that is granular rather than relying on the bulk deposit. So we are not in the market to pitch for open market, high cost deposits, which in the last 2 quarters we have desisted from. And for relationship accounts, larger relationships, we continue doing that. So our ratio of our bulk deposit is less than 6% right now on the total deposits.
You said you're well placed on NIMs. Is there a number that you are targeting, say in the first half of the year or the end of next year?
So there are two elements to NIM. In the last year, as you are aware, there was a penal charges which got implemented as against penal interest. So it moved away from the NIM. So I have to adjust the NIM. So the adjusted NIM is anywhere around 3.18% right now. And we believe that, this will grow at least about 10 to 12 bips now additionally, because of this churn that we are doing on the advances portfolio. Whereby the overall yield on the loans that we are incrementally putting on, and plus the pressure on deposits will come down because there are 2 rate cuts. So there have been changes to our deposit rate structure on the retail side. We have repriced them. But the transmission of this across the portfolio will take a little while, because most of the deposits are, as you're aware, 365 to 375 days. So I would say that 50% of the deposit number would get repriced this year. So there is a positive impact on both sides, which is the churn in the corporate portfolio and the EBLR advantage, plus the fact that the deposit rate repricing has already been put in place.
All right, Mr. Srikrishnan, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Karnataka Bank, the stock closing to the lowest point of the day, now 4% lower there on the stock. The markets continue to remain choppy, but we take a short break. The management of Sagility India joins us on the other side. Stay tuned.